Hello and welcome to this edition of Market Guru. Joining me today is our Sukumar of Franklin Asia Equities. Thanks very much, Sukumar. Always a pleasure talking to you. My first question, I want to go back to our last conversation, which was back in August. And I remember you mentioned that the uncertainty continues in the global economies and the global markets. But the point that you made that day was that the implied risk premium for equities is extremely elevated at this point of time. And equity as an asset class is definitely very attractive compared to other asset classes. We pretty much seem to be seeing that very point playing out, isn't it?
Yes, I clearly believe that equity is undervalued compared to other asset classes. For many countries, the implied equity risk premium is almost in double digits, which is way above normal. And the market seems to be very pessimistic about the earning prospects or about the fear of deflation. And I think the fears seem to be unfounded, and so I think that equity as a risk, as an asset class, has a very good possibility of outperforming the other classes.
How are you viewing global factors right now, Sukumar? If we were to look at, say, the US, Europe, China, how are you looking at things panning out there in these countries and regions?
Each of them have their own dynamics. The debt cycle is what has been affecting the Western economies. And US and Europe are not at the same stage. I think the unwinding started in US earlier, and Europe is more in the early part of the cycle. Whereas in the case of China, I think the issues are totally different. It's about the sustainability of the growth rates, not about excess debt. And they are facing some challenges. But I think the good news is that there's a cyclical recovery in the Chinese economy. I think the GDP growth rate seems to be bottoming out, and even the housing sector is seeing improved volumes and so on. In the case of US, I think there has been a reasonable amount of deleveraging which has already happened, and I think there has to be more deleveraging for sure. But I think it's something which is manageable. Of course, there are short-term concerns on fiscal cliff and the implications. But I think it's a problem which is easily surmountable, and I'm sure that they'll be able to find solutions to the problem.
You write in a recent note, your colleagues write, which says that mid and small cap stocks have been faring much better than large caps. Are we therefore, and you did in the previous interview to me mention the fact that it's more a stock specific story, while indices may not have moved much back then, it were really individual stocks which were moving. Is the focus now shifting towards largely the mid cap and small cap because the large caps have run up too much?
I think these things, there are short-term divergences in the performance of some of the asset classes within equities. But we believe stock selection is going to be more important. While one can play a little bit of valuation catch-up from time to time, we believe that the bigger outperformance or the higher proportion of alpha can be achieved by focusing on stock selection, and that is where we spend most of our time on. And we see clear opportunities on a bottom-up basis. So many of our portfolios have given fairly good absolute returns even in the last 1 year, and going forward we think that should continue, though there are going to be short-term divergences, but I think there's enough potential there.
In the same note, Sukumar, your colleague writes that you think that markets could maintain a positive trajectory over the near term except for any major negative surprises on the domestic and global front. On the domestic front, most of the growth issues are well recognized and priced in. What could these, according to you, the 2 or 3 real jammers or breaks, if you were to say, could be? What would you be looking out for?
If you are speaking about whether there are some factors which can elevate the risk level compared to what has already been budgeted or what people are prepared for, I think one of them is the rupee going to, let's say, 70 or 75. Obviously, a lot of things change, including the local cost of energy and so on. So I think that is a risk, but it looks quite unlikely that something like that will happen, because the rating agencies are also looking at the recent developments more favorably, and I don't think the outlook has worsened substantially. Of course, high inflation levels again can have an impact on the overall economy, because then interest rates might have to be increased if the inflation goes out of control. So I think everyone is cognizant of that, and I think the government policies seem to be addressing the inflation issues. Though one could wish that they could act faster, but I think in terms of direction, they seem to be moving the right direction.
Do you believe, Sukumar, that the worst is over for corporate India? You do make a point that the key would obviously be in kick-starting the investment cycle, but if you were to look at earnings numbers, if you were to look at what the RBI has done so far, of course it's not cut rates, but the effective rates at which corporates were borrowing has obviously come down. Do you believe that the worst is over, or we're still going to see some pain over the next 2-3 quarters?
In specific sectors, the things can worsen. For example, some commodities, especially metals, etc. If the prices or the margins continue to be very low, some of the companies might suffer, especially since they are adding to capacity and so on. But if you look at aggregate earnings, there has been a substantial compression in the margins. We believe that we are close to the lows in terms of margins, and I think over a period of time it can recover from here. And in many sectors, consolidation will aid the margin recovery. The margin compression has been because of excessive competition and excessive capacities in some sectors. And as the consolidation improves, I think there can be margin recovery.
The same note also talks about, Sukumar, the fact that FI holding in Indian equities is currently at an all-time high of about 16.6%, but yet we keep seeing billions of dollars continuing to come in. Is that something that, 2 questions here. One, does that surprise you? Second, where would then this money really go? Because if they're already fairly overexposed to the blue chips, where would they be really looking at? What sectors, according to you?
Money will go towards companies which show promise. Whether this percentage of foreign holding can continue to increase, I think it can continue to increase. I think in many markets it is higher, and India is seen as one of the most promising markets. So I wouldn't be surprised if we continue to see inflows. And I'm not just too worried about the percentage holding being at an all-time high. I think it can go higher.
I just want to discuss a few sectors with you, Sukumar, and I'm taking a bit of a cue from 2 of your most successful funds, perhaps India's most successful funds, if I may say so, over a long period of time. The biggest exposure across both these seems to be to banking and financials. There has been a lot of talk about the health of the banking sector, the level of NPAs, asset quality, etc. What is your own reading of what's really going on in the banking financial space?
We are seeing a divergence in the non-performing assets between private sector banks and public sector banks. In many of the private sector banks, we are not seeing substantial deterioration in asset quality, whereas in many of the public sector banks, we have seen a substantial deterioration. And this is partly because of the quality of the lending processes and the quality of the management. So we always had concerns about the effect of government ownership on the management of public sector banks, and I think there needs to be some structural changes to how the public sector banks are managed, or how they are governed, more importantly. So whether it will continue to deteriorate beyond redemption, I don't think that's my concern. Yes, I think from one of a stock in public sector banks is not very pleasant. Whether it's going to create systemic problem, I think it won't it won't erode capital completely, or it's not going to, I don't see a systemic problem in the banking space. But the PSU banks stocks might continue to underperform for some time.
Well, there has been a lot of talk, among experts, Sukumar, of moving away from defensives like pharma, FMCG, because they're overvalued. I find that at least in the Franklin India Blue Chip Fund, the faith in pharma continues to be there in terms of the exposure. Are you of the view that the defensives, while maybe extremely expensive, still provide tremendous amount of value even from these levels?
The names that we hold, yes, we are confident that there is a lot of value at the current prices. And so we don't just look at the P multiple, we look at the type of economic value a company is going to create based on the competitive advantages that they enjoy. And in the case of our holdings, we have done a thorough analysis on each of those counters, and we feel confident that there's a lot of value there.
After what you've seen of the more recent earnings, do you believe the future could turn around for the Indian IT sector, Sukumar?
It depends on what we term as a turnaround. If you're expecting that the growth levels will go back to what we saw some time ago, let's say 4 or 5 years ago, it's quite unlikely, because the penetration of Indian companies of the US Fortune 500 companies is pretty high, and further growth from a large base will be slower. And also there's increased competition between the Indian players, which was not the case 4 or 5 years back. So the increased competition has also lowered the margins. So I think there can be growth, there can be further value accretion, but the dynamics are not the same.
How are you reading the rupee? Just when everybody thought, and even when we last spoke back in August, that it was getting stable, it slipped again, and it's fairly weak. You told me last time you felt it was quite undervalued. What's your view on the rupee?
From a long-term point of view, on a purchasing power parity basis, it's still undervalued. But for the confidence in the rupee to be higher, I think the inflation has to be under control, and I think that's critical. And the fiscal, the deficit and the various deficits have to be under control. So as long as we can achieve normality in bringing down the fiscal and the current account deficits to more acceptable levels, I think the confidence in rupee will improve substantially.
Are you beginning to see any strong interest at all coming in, Sukumar, from the retail investor?
Historically, retail investors have come in when I think the foreign investors have created a rally in the market. So we haven't seen a big rally yet. So it would be premature to expect big retail interest in the market. Usually they come in after there's a more pronounced rally.
I'm asking you this because the latest numbers even suggest that even the amount of cancellations of SIPs has only increased across the industry, which clearly means that the measures that we were hoping would bring back or encourage more distribution of products doesn't seem to have worked.
It's a slow process, so we have to be patient, I guess.
All right, Sukumar, we leave it there. Thank you very much for joining us, like always, here on Market Guru.
Thank you.
That was R. Sukumar of Franklin Asia Equities on Market Guru. We take a quick break, but lots more coming up on Bloomberg TV India.